Hey, Adam Hooksema here from ProjectionHub, and in this video, I'm going to talk about how to acquire a business that is really volatile, where maybe profits or revenue can be significantly different year to year. And how's an SBA lender going to look at that, and how should you be thinking about that as a buyer? And so what I'm going to do is I'll show you an actual example of a client that I was trying to help with an SBA acquisition. This was for an HVAC company, and there was a lot of volatility because the seller had a very substantial commercial project. They mostly just did small residential jobs, but one year they got a big commercial job. It jacked up revenue, and then the next year revenue came back down to kind of a baseline. And so how should you as a buyer think about that? What's a SBA lender going to do with that, and how does that impact the pricing and the amount of an SBA loan that you can actually secure? So I'm going to kind of talk through that from the numbers perspective here. So to demonstrate this, I've got the financials of the seller in our model here, and this is our acquisition projection template. If you want to use this, I'll put a link in the description of the video below so you can grab this and use it for your own modeling of an acquisition. But one thing I want to point out is that once you get it all filled out, you're going to see this debt service coverage ratio. Now, this is where, this is the key number that an SBA lender is going to be looking at to see, can this business cash flow the proposed loan? And so typically for a business that's really steady and stable and kind of just growing slowly, you might be able to get away with a debt service coverage ratio of 1.25 as kind of typically the minimum, meaning you have $1.25 of cash flow here for every dollar of annual loan payments or debt service. So the 1.25 is kind of the norm on the low end. But in this case, because it's such a volatile business, the lender probably is going to want you to have a higher debt service coverage ratio. So let's just take a look at how we model this. So we start by getting the historical tax return data into the model. So you can see the last 3 years and you see this huge jump. So 22 and 23 were almost right in line with $300,000 in sales. 24, all of a sudden a $1.2 million year in revenue. But what we can see here, so we get all of their expenses into the model to come up with the net income, and then we have add backs, so things like depreciation or compensation of officers here, to end up with our estimated cash flow. Now what we do in our template here is we look at, okay, based on the proposed loan, would this business have been able to cash flow this proposed loan in the previous years? And what we see here in the really high year in 2024, there was tons of debt service coverage, 3.31, but in 22 it was not even 1-to-1. 23 just above that 1.25 number, and now back in 25 year to date, we're cash flowing at the proposed loan amount. Now, what we do here is we put in the proposed loan amount here. In this case was a $550,000 loan. So typically the lender is going to want to see that you can cash flow that loan in each of the last 3 years, especially. So they're going to look at it and say, hey, we want to see in the worst year of the 3 that you can hit that 1.25. So if you have a seller, the risk here is that as a buyer, you come in and you're buying after 2024 numbers and you see this huge run up, right? And you think, oh, I can pay more for the business because it's a lot more profitable, right? And you pay a multiple of that. But that was really one-time work. It's not sustainable. And we see in 25, it came back down. And so the way that an SBA lender is going to kind of protect you as the buyer in that situation is say, hey, it needs to cash flow each of the last 3 years. And if the challenge you're going to run into probably is that the seller is going to say, well, I don't want to sell you my business for only $550,000. I did $303,000 of cash flow just last year alone. You as the buyer, though, you can't justify, and the SBA lender is not going to allow you to justify paying that much just based on a 1-year trend. So what you're likely going to need to do is bring that price point down until you get to a point where you're cash flowing each of the previous 3 years. So if we were at a $450,000 purchase price, let's just see. So that gets us to 1.12. Going to have to go even lower, maybe 400,000. That gets us to right at that 1.25. So in this scenario, you're probably looking somewhere closer to 400,000 from an SBA loan perspective. And then maybe you can do a seller note on top of that that's on standby. over a period of time. So that's the way you're probably going to need to think about a really volatile business, is what does the deal look like in the worst years? I hope that's been helpful. If you have questions or you have a deal you want me to take a look at, feel free to reach out to me directly at adam@projectionhub.com. We also offer a free SBA review. You can see the link in the description of the video below to that free SBA review. Feel free to provide a little bit more context and I'll give you my free feedback based on my experience. All right, thanks.